Hello and welcome to Erik Penser Bank. My name is Jonas Thudin. I'm head of asset management and I will go through our house view. And it's been a while, but our call to add risk and add cash and drop protections on around the 20th of June stands, and I will explain a little bit more why. The methodology is the same. We would agree with UBS as a fun little quote here that given the sell-off this week, this is a reason to find opportunities. We are planning a reallocation in the portfolios. We don't take down risk or anything like that. We dropped 0.8% over the CPI number. The global equities lost 3.3, and we had a number of equity positions that actually increased in value. So for us, it wasn't really a cause of major concern. I think the broader picture on where inflation is heading is a lot more important, and I will come back to that. Now, the allocation on the broad portfolios, if you look at a medium-term risk portfolio compared to listed competitors, is of course we're still outperforming by a bit over 7% per annum. And the reason I think is solely 100% down to how lucky or how efficient have your tactical asset allocation work been. Strategic asset allocation used to account for a large part of the returns. This year, none. It's all down to tactical. So and that of course has benefited us quite well because we are a tactical and active house. In terms of this, as you can see, from the end of June to overweight equities, going from 40-60 to 60-40, for example, on the index level, you actually made 3 times more profit. So it has proven to be the right call this time around, and we're going to stick to that. And our medium risk portfolio is down 5.5% this year. On an index level, we're down 17.5%. So it's 12% difference, which is abnormally high. And that all comes down to, are you able to be active? Are you able to be tactical? And for us, that means that we have spent a lot of the risk portfolio in equities, which has been a free option in the sense that yields have returned equally as bad on a global benchmark basis. Hence, you're almost given a free option to keep equities where it can work, I would think, easier in terms of vol hedging, shorting, FX exposures, etc., and being able to limit and pull away from a theoretical index portfolio by 12 percentage points is quite a lot. We're still down and we're still working on that. But abnormally high, I would think. And also this call of increasing in June has so far proven to be the right thing. For the last 3 months, our global equity portfolio is down 7.8% positive return. So we think we can easily handle this week's headwind in that sense. Now, in terms of the overall call, we're still in this camp that, yes, price inflation peaked in March. There's nothing new to that. If you're trading inflation, that's when you should have gone for lower inflation. Peak yields, we're still keeping our curve steepener position on in dollars. It still actually generates positive returns. And also we can clearly see the end of Federal Reserve hawkishness. Now, importantly, we do not think there will be a recession in 2022. We never thought that would happen either, and we're quite positive into Q3, and I'll come back to that. We're still in a soft landing camp. We don't have to go through this model, but this is pretty much the calculation the Fed has given us, that we've gone away from a hard landing to a soft landing. As long as we are arithmetically at least in a soft landing, we're going to stick to that camp, i.e. the Fed can hike rates without creating too much negative distortions on the labor market. Now we also must remember that the media picture is about 2.5 times as negative as what's been priced in terms of stress in the financial markets. This is a trend that started perhaps with Trump and Brexit, but ever since, and also maybe some clickbait economy, we have a media picture. There's a lot more stress than underlying sentiment, and I think this past week has been quite illustrative in that sense. How often do you open up the newspaper and read, well, actually the sentiment amongst professional institutions is increasing this week? Have you turned more bullish? Have you worked your portfolios in that sense? Or are we just, risk off and a nervousness? I would be able to bet that probably 90% of what we read is negative, which goes contrary to how professional institutions have been trading this week, which is quite interesting. Right or wrong, it is what it is, but it's also quite interesting. But that's just something we have to keep in mind. Now, in terms of inflation, we've argued for a long time. I mean, just look at break-evens. They peaked in March. This is an old trade, 6 months old. Swaptions actually came down this week. We know that credit card expenditures is coming off. We know that given break-even curves are coming off. Unless CPI increases by 0.5% each month, we will have deflation within mid-year 2023. This is why Jeff Grundack and others have been starting to warn, I think, for that deflation is a bigger risk. But it's also quite interesting to remember that inflation is arithmetically just a derivative of a cost basket in that sense. Hence, if it increases by less than 0.3 each month, you will have a sharply deteriorating growth number. It's a growth number we're talking about, nothing else. And that's probably why a lot of people are looking at this side, and obviously why it coincides with Fed cuts. Also, this is mirrored by commodities, again, by the swaption market. It's been mirrored by supply chains, which are unraveling quite drastically. There pretty much no lag in terms of shipping in the US, in terms of on the cargo in St. Peter and Long Beach. We also know that the price plans from US corporates is unraveling quite aggressively. We also know the wage pressure is still increasing, but lower increasing. So the second derivative has turned negative, which means also the headline second derivative turns negative, which it has done for a couple of months. And we also know the consumer, their expected rate of inflation rate next year, it has gone from 8.6% to 3%. So it's very difficult for us to come to the conclusion that CPI has not peaked. I would argue the other side, that everything is clear, send us a clear message. Inflation has peaked. We now know the Fed will hike rates. They will hike it by 75 basis points. I think it's about 83, 84 basis points being priced in. But they will hike rates. But lo and behold, as the year-on-year growth numbers roll over quite aggressively in the US CPI numbers, they will start cutting rates. So we're in the second half. We're already into the second half. And that's why we think the market becomes more and more prone, being potential for rebound, which is why I think equity sentiment increased this week despite the CPI number, because people are starting to sniff this out. So you like to see the fact that you get 5% discount on Nasdaq overnight. Great if you have cash. So I think that's why equity sentiment has been increasing. Now, Fed will obviously run into some kind of cold waters here and probably going to slow down the increasing trajectory. One reason is this old theory which changed the whole idea of how work in the interest rate market that was before the Ukraine war, i.e. they look at the most vulnerable demographics in terms of rate policy, in terms of labor markets and earnings, and obviously it has to do with the Gini coefficients and everything else. But they don't want to repeat the 2000 or 2006 mistakes by hiking too much, given what the underlying demographic factors can handle. We are actually repeating that again. Obviously, they have a good cause now. We have this inflation to take care of, but this is also why the market is smelling out cuts already. And it's been that way for some time. I.e., you don't have the fundamental factors with you. So that's quite interesting to keep in mind. Now, obviously, we would argue that the 10-year yield should be lower than it is today. This is not a trade we have on the books. We have a curve steepener on in dollar terms, completely unhedged versus SEK. So it's more of a little bit of a chicken game in that sense, rather than being just outright long the 10-year. But it creates a lot nicer vol that goes into the portfolios, you can imagine. So that's the position we have. Yes, the central bank balance sheets is deteriorating and they're squeezing this away, which we know, yes, it will have limiting factor on CPI as well. I will not go through this slide, but it's quite important to remember that the US is handling their interbank market very well. They have learned from the 2019 mistakes when we saw some blowouts and we saw some banks having to face massive rate in the market just to finance themselves. It's very interesting to remember this slide when we look into Europe, because when the US has been able to tighten the financial conditions, as you can see on the right-hand axis, but keeping it just steady, but also constantly tightening it. In Europe, you were able to keep up with the US, but then it sort of lost the grip. So right now, the financial conditions in Europe is deteriorating quite rapidly. this has severe consequences for how the market is functioning. You can just look at Germany, for example, where the rate policy from the ECB has a hard time going into the economy and the rate papers because of QE, which is vacuuming up all the papers. It's a complex relationship, but it's definitely playing against Europe. Our simple conclusion to this is we're out. We don't have an underweight to Eurozone. We have 0% weight on the Eurozone. Now, as I said before, it's quite interesting to study sentiment. And now sentiment has to lead the equity market. It is not enough for us to look at sentiment. There are sentiment indicators out there that are following, i.e. being autocorrelated. We like the fact that sentiment leads the equity market, both on downside and upside. So when we look at traditional institutional investor sentiments, you can probably guess which one they are. They increased this week, which is quite interesting given how the equity market. For us, that's an interesting opportunity. And this is why I think the UBS came up with this quote, which is why I think institutions have been buying into the equity market this week. Right or wrong. We, of course, like to see the fact because we put our last chips on the table on the 20th of June and been enjoying this trip. And obviously, if we take out new lows, we have to rethink it. Otherwise, we can stick to it. Also positive is the risk in the equity market has not shifted into CDS's rate spreads, FX vol, fixed income, vol, emerging market spreads, i.e. that risk indicator is still showing upside for the equity market. If you look at high lows, advanced declines, etc., they are still actually quite constructive on the upside. Note again what happened in June. We saw a tremendous move on the upside, which we utilized in the portfolios. They've made a good call since then. And it will be interesting if this develops into something similar to that. At least it's not negative. And this, of course, is the most important chart. Again, note the date, 20th of June. Blow up on the upside, i.e. if you look at counterparty risk, dollar liquidity, vol curves on a daily basis, daily traded contracts, we can see that the latest downturn in the equity market is not at all replicated in these markets, and they tend to lead the equity market. So obviously we're talking and we're biased, we talk our own book here, but we'd rather keep equity risk, betting that the equity market will catch up rather than the other one should fall down. So, and importantly then, as I mentioned before, the smart money index is obviously also increasing, i.e. institutions agree with us in terms of professional investors, so we can keep on this and hope that retail flows will come along. Because if you compare retail sentiment to professional institutions sentiment, you can almost see the same pattern that we've seen in big market troughs, like the New Year's 18-19, like the pandemic, and what we saw this summer. All of a sudden you see a burst of institutional professional investor sentiment, and you don't see the same in terms of the consumers. And that has been the big troughs in the market that we do not want to miss. And I think this is the curse of the retail investors. It's very difficult to see these troughs and see this data, which I have full respect for. And obviously we're biased. We're talking our own book in that sense, but we put our foot down on the 20th of June and we're sticking to that for the time being. Now, luckily, the option market agrees with us, so this kind of positive. It's a small signal still, but it's definitely a lot more positive than being flat or falling in terms of how puts and calls are in the market. These type of troughs have historically been quite good signals for the equity market. And we're keeping growth. Remember now, growth for us is especially clean tech. Our clean tech strategies, we have 2 of them, so about 10% of our global portfolios in clean tech. They made 27 and 28% return on the last 3 months. Again, being led by this indicator that shows that we should keep growth equities in the portfolio. Now, importantly, again, remember the date, 20th of June, we will start to see some quite interesting shifts already in May in terms of price target estimate revisions, earnings estimate revisions, profit outlook, and data surprises. Since then, they've all developed positively, making an overall regression showing that Q4 could be quite good for equities. Now, these can trend lower again and they can change and we will adopt accordingly. But so far, to overweight equities in end June makes you 3 times better returns on a 40-60 compared to a 60-40 global portfolio. That was a big call, and I think that's sort of what we enjoy making in the sense that we need to beat and capture those troughs more than anything else, especially when they're supported by earnings revisions, price target revisions, economic data, profit outlooks. So for us, it's more of a, I mean, you've always been inclined to ask the question, why shouldn't you increase risk given data? Because again, everything in terms of inflation shows a clear peak. Again, this is a US call, remember that. Well, we also have quite big investments in Japan, India, and China, and Latin America, nothing in the Eurozone. Remember that the follow-through from US equity market, European equity markets is about 15%. So we have 85% unique European equity risk. And that, unfortunately, is negative. Unfortunately, we cannot keep up with global equity markets in that sense, which is why stock picking is very important. And why we make quite substantial shifts in our large cap portfolio since this summer in the Swedish one. But we make a separate video on that coming up. Now the recession in the US, yes, we can see there's a 20-25% recession risk in the next 12 months, but it's not an issue for today. Given the fact we're already priced recession and the rates have done equally bad, you're almost given a free option to keep equity risk. Now for the next 12 months, we see a 22% recession risk if you look at credit spreads and calculate the way the Fed calculates risk. We see that we don't actually have a slowing momentum in any US state, so making a recession call today is a bit fluky, I would say, in the sense that you don't have a single state that sort of shows that yes, we have an issue, we have a slower activity. Now you have the SAM rule, far away from recession call. If you have a bit more advanced business confidence measurements by doing Aruba, Diebold, and Scotty calculations, you can actually see it's increasing in the US. So it's very difficult to find this slowdown in 2022. It is a 2023, 2024 story, but remember by then the Fed will actually start cutting rates. So everything will change when we get there anyway. So for us, it's been a clear, straightforward path this year. It wouldn't have been that straightforward if rates were not selling off quite as bad, but now they have. So it is more, you know, the market is always our correct measurement in that sense. That's always they're always right in that sense. Now, in terms of macro variables to define US recession, you can see them listed here. You can't really see a slowdown. You can actually see a continued improvement. So for us, this whole recession call is a little bit weird. Again, you know, look at economic surprise in the US. They trough and turn around again around the 20th of June. Everything changed then. You need to capture that, we would argue, and enjoy and ride that wave of increased risk. Now, when we look out for this next coming week, we already talked about the FOMC, 75 basis points hikes. Then we have the Riksbank, which, you know, their forecasts are also a bit iffy. This time around, we think they are more right in forecasting a lower trajectory than the rate market. Now, the rate market is showing that they will cut again, but I think this is a fluke in the sense that there is no liquidity in these contracts, and I'll come back to that later on. We don't think that will materialize. However, it's quite interesting now to see that Sweden is hiking rates in an environment where we have the retail sales, which is the lowest, collapsing compared to the financial crisis or 90s crisis. We have real wages obviously being very, very low. We have a debt service ratio amongst US consumers, which is record high compared to record low in the US. And we also have a CPI driven by supply factors, not demand factors, which makes you wonder why on earth should we hike in the first place. But then again, we're a suburb to ECB, so if they decide to hike, we're going to hike as well. I'll be a bit north there in my comments, but at the end of the day is we have to be very careful about Swedish equity selection, which is why we made a lot of changes running up to this this new trajectory on or this hike that we will do next week. And also be quite prepared that, you know, we can trade Swedish equities as long as the correlation to US macro is a lot stronger than Swedish macro. So we have to keep, you know, different thoughts going on at the same time here. I think that we have to realize that yes, we have an issue in Sweden in terms of we're hiking rates given this debt situation and given our you know, inflation being supply driven. But then again, OMX is driven by US macro. Then again, we see liquidity issues on the First North list, for example, where it take about us you know, between 2 and 3 weeks to trade small amounts on the equity side. That's more of a buy and hold area. All that influences the stock picking, which is why we will break out and make smaller moves on actual stock picking. Now, behind all this, as I've been alluding on, is that the systematic risk in Sweden is very, very high. It's the highest in Europe. Higher than the Italian crisis or the Greek crisis. We're almost back to the very severe Greek crisis in 2010, 2011. The obvious way for us to trade this is to be very selective on stock picking, and by all means necessary, you have to exploit the Swedish krona and the dollar strength or euro strength or et cetera, even NOK. So it's a game that's also been played out globally, i.e. the European systematic stress compared to the US is a lot higher. Remember what I said about before, when the US learned from the pandemic, when they actually had the highest systematic risk, they buy-sided or step-sided the banking industry and said, you know, corporates can go and borrow money from the Fed directly. They started loaning desk on the Federal Reserve just to sort of get rid of the systematic stress. In Europe, we right now have a very, very poor situation. Systematic stress is driven by banks, but we do not really do anything about this. We're going to hike rates instead because we have a supply-driven CPI. This all makes it quite easy to understand why the market is skeptical on Eurozone equities, why the relationship between US and European equities is very, very low, 0.15. We also need to remember that US credit impulse indicator is very strong. Globally, credit impulse is increasing. Remember the financial conditions data series for Europe, which is very, very low and collapsing. Completely different sets of conditions to trade equities. And also in the US, we shouldn't go through this, but you know, out there on the limb, we know that, you know, share buybacks is a huge factor in the US. We have abundance of cash in the US corporates. We know there's going to be a new law coming in for share buybacks by next year. So the probability of seeing increased share buybacks going into year end is quite big, we think, which is why we like to have that optionality or that risk in the books as well. That was all, hopefully a bit shorter than you have the longer one in the Swedish version. You have all this material on my social pages. We can see it on Instagram or on Twitter, on LinkedIn. And we're happy to take any comments you have. And if well, I have nothing more to add, so I will see you in a week, and thank you so much for your attention. Thank you.